Hi all. Today we'll be having a session on management of financial services. Basically, this session would be with respect to an introduction to what financial services are, and we'll be dealing with a financial system. So basically, a financial system is a very broad term for all things that constitute financial intermediaries, financial assets, and all financial aspects that happen in a economy. So it is not a very small or specific term. It encompasses a lot of things that includes your normal capital market, money market, and other things also that are there in a economy. So there are several functions of a financial system. The first major function is provision of liquidity. Whenever you have assets, whenever you have an asset, it is not useful till you have a certain degree of liquidity attached to the asset. Now, assets generally, whatever assets you have gold, you have land, you might have buildings or any other assets. The major problem with assets is if you do not have a degree of liquidity, you cannot sell those assets. So if assets are not sellable or if they are not liquid, people do not hold assets. That is why people tend to hold gold more than your land or other buildings, because gold is easily very liquid. So in this specific case, the major job of a financial system is to provide financial liquidity for any assets that the investors hold. Now the second thing is your mobilization of savings. People have a lot of savings at their homes, and we all expect them to bring those savings and put it into the market. But the problem here is if you do not have a specific system that brings in these savings to the market, it will not be possible for normal investors or small time investors to invest in big companies. So financial systems create an environment, or they create a provision in which people can take out their small savings and invest in bigger companies. So that is how a financial system creates an environment in which you can take out savings of small time investors and bring those savings for the national good. Then you have size transformation function. It is related to your mobilization of savings. Now, size transformation means, because as I said before, if you have only small investments, or if you have huge companies that require a huge amount of money also, they cannot get it from maybe a single source. So you would require a lot of different people pulling in a small amount of money and then investing in a bigger company. So this size transformation means even small investors can invest in big companies, and even bigger companies can get investments from even small unit of investors. Then you have maturity transformation function. Maturity transformation means whenever people tend to invest, they have a specific time period wherein they want their money back. Now that time period in which they want their money back is your maturity date or your maturity period. Now this may be different from person to person. Now what we tend to do as investors is we go to a money market or any capital market, and then we look for different assets or different investments which meet our maturity expectations. So that system should be such that every financial system should be such that it provides certain options to each investor so that they get investments that match their maturity needs. Now, maturity needs can be different from person to person. For example, I might require maturity period for about 1 year. Somebody else might be ready to invest for about maybe 5 years or 6 years. So you should have products that cater to everybody's need. Then you have risk transformation function. Now, similarly, that is also there. People need to hedge their risk. Hedging means they need to reduce their risk in some form. So people go to the market to reduce their amount of risk. So the system, as financial system, would have several people or several products or services that help people to reduce the amount of risk that they are taking, and would provide them with services or products that help them to hedge their risk. Then, in order to understand how a financial system works, we need to have a certain idea of certain terms: financial assets, financial intermediaries, financial markets, financial rates of return, and financial instruments. In this specific video, we'll be discussing only the first two aspects, which are the financial assets and financial intermediaries. Now, financial assets means it is not very similar. It is similar to your normal assets, physical assets like your gold, land, or building. But financial assets are a bit similar because basically they are not very common in a sense. So financial assets are used to create, or they are used to convert the older normal physical assets to digital assets. You can do that in a digital form. You can have financial assets in that form also. And unlike physical assets, they cannot be used for further production of other goods and services. For example, you can use gold to produce more other ornaments and other things, but you cannot use bonds or debentures to produce more bonds and debentures. So that cannot be done. So basically, financial assets are used to ensure that you have a specific degree of liquidity in the market, and they also sometimes act as a system or a special purpose vehicle, so that you can carry on your normal assets, take your normal assets, convert it into your SPV or special purpose vehicle, and then move on and do your normal transactions. Now, what are the different types of financial assets? So the broad classification is of two types. You have your marketable assets and non-marketable assets. Marketable assets means you can easily transfer it from one person to the another. So for example, if I have an asset, for example, if I have a share or bond, I can sell this share or bond to somebody else, and he can buy this share and bond, and then he can also transfer it to somebody else. So these are transferable assets. You can transfer the ownership. Basically, you can sell them very easily and you can get money out of it, and the asset can be transferred from one person to another. Now, similarly, you have non-marketable assets. These are those assets that you cannot sell very easily. Okay, these are there with you. For example, your bank deposits. You cannot sell your bank deposit. All you can do is take out money from your bank deposit and then give it to somebody else. You cannot take your bank deposit or FD receipt and sell it to somebody else. So it is not transferable basically. So you cannot transfer from person to person. Then you have basically this is your classification between marketable assets and non-marketable assets. Marketable assets means you have your shares. As I said before, you can sell shares very easily. You can also sell your government securities. You can sell your bonds. You can also sell your mutual funds. You can also sell your UTI units. You can also sell your bearer debentures. Now, bearer debentures, now there is a small bit of understanding that is required in terms of bearer instruments. Now, bearer instruments means a person who has that instrument is the owner of that instrument. So that is a bearer instrument. It is not like the name of the person is written on that instrument. Your normal 10 rupee or 100 rupee note is also a bearer instrument, in which any person who holds that note is basically the owner of that note. So that is how a bearer instrument functions. So similarly, you have a bearer debenture, that whoever is the owner of the debenture, or whoever actually holds the debenture is the owner of the debenture. Then you have your shares, as I said before, government securities. You have mutual fund units. That is, your mutual funds are generally divided into certain units, okay, on the basis of their net asset value. For example, if you have a 1 lakh worth mutual fund, it's very small number. Actually, you have a huge mutual fund, but if you can have a 1 lakh, for the sake of example, if you take a 1 lakh mutual fund, what happens is it is divided into several units, small units, which are then sold to different people. Now, these mutual fund units can also be sold. You can sell your mutual fund units. You can buy them. You can also sell them. And in a similar format, you also have your Unit Trust of India units. These units function exactly like a mutual fund unit. So they have a same method of doing it. So you can take the entire fund, break it down into certain small units, and then sell it. So that is it. Then you have your non-marketable assets. That is your bank deposits. As I said before, you cannot sell your bank deposits. You also cannot sell your pension funds. For example, if you have a pension funds in your PPF account, you cannot sell that account to somebody. All you can do is take out money from it as a loan, or you can close that account and then take that money and give it to somebody else. Then you have your LIC schemes. If you have an LIC scheme, all you can do is you can do two things with your LIC scheme. Either you can assign it to somebody. That is, the benefits of the scheme would be given to somebody for a specific amount of time, only for a specific amount of time, or you can nominate somebody. That is, whenever the maturity of the policy happens, maybe somebody else will get the benefit out of it. Then you have company deposits. In some cases, you deposit your money into certain companies when they solicit for some amount of cash. But in that case also, you cannot sell it to somebody. Similarly, you have your post office deposits. These are the oldest forms of deposits you generally find, but you cannot sell your Kisan Vikas Patra or your post office certificate to somebody because you want a certain amount of money. If you want liquid, easily sellable assets, you would require your marketable assets like shares, government securities, bonds, and other things. Then there is other classification also. You have cash assets, for example, your normal coins, your rupee notes, all of these are your cash assets. Then you have your debt assets, for example, your debentures, which are issued whenever you take a loan, okay, from a bank. For the bank, it becomes an asset. Okay. Whenever we take a loan from a bank, for a bank, it becomes an asset. It may be a working capital loan, it may be a term loan, or even a debenture is a debt asset. Because when companies need money, they would issue debentures, and for that specific debenture, companies will get a certain amount of money. So that is what debt assets mean. Then you have your stock assets. For example, your stocks held by the company. There are many cases in which the stocks are held by the company. For example, their own shares, securities that the company has. So they are also considered as an asset. So this is another classification of cash assets, debt assets, and stock assets. And as I said before, we just have to move back to help you understand how this is classified. So these are your financial functions, the financial system, in which, as I said before, you have certain concepts to understand. You have your financial assets and then your financial intermediaries. So we'll be moving on to your financial intermediaries. This is the image. Yeah, the image is up. Now, what happens is your financial intermediaries are basically organized into two sets. You have your organized sector and also your unorganized sector. Organized sector means generally you have certain rules and regulations, and they're regulated generally by the government. Okay, there are certain set of rules. They cannot go out of it. But when you look at an unorganized sector, there is no specific structure or a system to which they adhere to. There is no specific thing. So that is why they're known as an unorganized sector. So I'll start off with the unorganized sector first, in which you have normal money lenders. As you know, you always have money lenders in the system. They are generally ready to lend money without much documentation. So it is easy to sell. That is why it is money lenders. Then you have your indigenous bankers, your normal small time bankers who can sell or they can give you a small loans also. You have pawn brokers, in which you can give your normal gold, or you can pawn your normal small things, and then you give you money for it. Then you have normal traders and landlords. Traders and landlords means what happens with traders, for example, they might give you a 2 or 3 months credit. If you take stock from them, they'll tell you, okay, you don't give me money back only after 3 months. So it is a type of loan. That is why traders and landlords. Landlords means they would tell you, okay, you can pay your rent in 3 or 4 months. And that is how traders and landlords. Okay. Then you have your organized sector, in which you start off with your capital market intermediaries and money market intermediaries. Okay. Capital market intermediaries. So before that, if we move on, I'll just give you a small intro to capital market and money market. The capital market is basically your long-term market when you go for your long-term fund requirements, and money market is your short-term market wherein you go for your short-term monetary requirements. So in the capital market, you have different intermediaries. These are people who function who help function the system, who help improve the system, or to help you to work the system. Then you have, in which you have your development banks, and you have your insurance companies, your LIC, GIC, and other companies. Then you have your UTI, or your Unit Trust of India, and then you have agricultural financing institutions. You would also have your government, in terms, because government might be interfering in terms of your PF or national savings schemes and other things. You have IRBI, export import banks, NBFCs. NBFCs are of different types. You can have hire purchase companies, leasing companies, investment companies, and finance companies. And similarly, in money market intermediaries, you will have your RBI, which governs the entire system in a sense. Okay, it looks at all banking functions. For banking functions, the entire regulation is done by RBI, and for other functions, it is done by SEBI, all stock market related functions. Then you have commercial banks, cooperative banks, you have post office savings banks, and the government treasury bills. So these are different intermediaries that function in the financial system, and they ensure that the system runs smoothly and the system provides a lot of services to its users. Okay, so we'll stop the video here, and then we'll discuss about the other factors in the next video. Thank you.